something changed with crypto here and no one's talking about it. And this is a specific reason that I talk about this stuff is I'm giving you guys the master class. Okay. This is exactly how I determine trend of a crypto, of a stock, of anything. And the most important thing to remember is I have a definable way to determine a trend, and I respect that. And regardless of what my feelings tell me, regardless of what the fundamentals tell me, regardless of what I want to happen, what I hope will happen, what I need to happen, I trust this definable way of determining trend. So before we get started, we're going to take a look at Bitcoin here. I want to remind you, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. You might not agree with what I'm about to say, but I'm telling you what I do, how I do things. And I'm going to explain to you exactly how this indicator that I designed to literally quantify my determinant of trend works. So today I'm going to go through a deep dive on the TJD Master. We're going to do a few minutes on this and then take a look specifically at this, and then we're going to see what it's telling us about, Bitcoin, crypto, etc. So the TJD Master has multiple components. Each of the components is simple enough on its own, but as you can see here, the purpose of this is to define the trend. So we have two blue moving averages. We have the bright blue and the darker blue. That's the 200 exponential moving average and the 200 simple moving average. The only difference between those is when I switch time frames, they both look back 200 periods. So I'm on the daily time frame right now. So what that does is it takes the last 200 days, it adds all of them together, whatever the price was at close on each of those days, and then it divides it by 200, and then it gives me the average. And then it plots that line right there. And then the next day it does the same thing and the same thing and the same thing and the same thing. And it just keeps going like that. The 200 exponential moving average versus the simple, the difference is with the simple, every one of those days is weighted evenly. With the 200 exponential, part of the formula for the 200 exponential moving averages is that the most recent time frame has a higher bias of importance. So what that means is the day 200 days ago, the last day before it drops off, is weighted less important than the most recent day. So what happened yesterday is more important than what happened, 200 days ago. And that makes sense because, especially when we're looking at cryptos or more volatile assets, it makes sense to use the 200 exponential because the moves tend to be more violent and, more aggressive. But by using both of these, we gain an advantage over the market because there's a certain number of people that use simple moving averages. There's a certain number of people that use exponential moving averages. And the rationale being the 200 simple moving average is what Wall Street's used. It's what they've used since the beginning of time. Since there was a quantifiable moving average, since back in the day where they literally would hand calculate these and plot them by hand on a chart and figure out the moving average and then determine, were we in an uptrend or a downtrend? Should you buy or should you sell, etc. So the 200 exponential moving average is more popular in crypto and, more volatile markets. So by using both those, we're taking into account what everyone that's using a 200 moving average, whether it's exponential or simple, is looking at. So now how do we decide though? Sometimes we break below one and we find support at the other. Sometimes we break below the opposite one and find support at the other. So by having both of them though, we can look and see, are they agreeing with us? Therefore, they're both validating what we're looking at. Are they disagreeing? Therefore, they have 50-50. So, it could go either way. Or, opposite. Is one saying this and the other saying that? Is the first one saying the opposite and the second one saying this? And Bitcoin is a perfect example of that right now. I'm going to switch over real quick. This is the Bitcoin futures chart. And we can see here that the 200 exponential moving average was on top and now it is on bottom. And then the 200 simple moving average was on bottom and now it is on top. Now I want to switch over to the spot market and we're going to see that difference in full action. So now here's the daily on the spot market and we can see that the 200 exponential crossed above, but then the 200 simple went above here and now the 200 exponential is back above again. So here we see the 200 exponential on top and the 200 simple on the bottom. And then on the Bitcoin futures chart, we see the 200 simple is still on top and the 200 exponential is still on the bottom. So what we saw happen was a bunch of price action that took place over the weekend while the spot market was closed, while the futures market was closed affected those moving averages and essentially made it so those numbers don't line up. Therefore, the exponential and simple moving averages don't line up in the same way. So if one was looking at only the Bitcoin futures chart or only the Bitcoin spot chart, only the 200 exponential moving average or only the 200 simple moving average, they might get a different picture. And I guarantee you right now, there's a large portion of people that are only looking at futures or only looking at spot. They're only looking at 200 exponential. They're only looking at 200 simple. So by looking at both those charts, by looking at both those moving averages on both those charts, we now have 4 times the advantage of a typical person who's looking at one of those. Because essentially when you have multiple variables, you can take those 2 variables, which is Bitcoin spot and Bitcoin futures, and then you can take the other 2 variables, which is the 200 exponential or 200 simple, and you multiply them together to get like the total number of variables you have. So if there's 2 different charts with 2 variables on each chart, we now have 4 potential possibilities for what you could see. And in this case, all 4 of those possibilities are showing you something different. So by looking at these 4 possibilities, we now have, arguably 4 times the advantage over someone that's just looking at futures or just looking at spot, just looking at, 200, just looking at 200 simple, etc. So now that you have the basic laydown of what's going on and why it's so important for the 200 exponential and simple, let's determine what does that actually tell us, and then we're going to talk about the other moving averages as well. So the way this is coded right now on this chart, the 200 exponential and the 200 simple are obviously both coded on here. But more importantly, what they're telling us is, and I'm going to turn off the actual price action for just a second so we can just see the actual lines themselves. What they're telling us is when the slope is to the upside, when they have a positive slope, they are both blue. The bright blue is the 200 exponential, the dark blue is the 200 simple. When the slope is flat or negative, they switch to red. So the 200 exponential switches to like this red right here. The 200 simple switches to like this pink or like, purpley kind of red, whatever you want to call it, depending on what your colors look like compared to mine. So the idea being that once the slope changes on these, they change colors. So you can just flip at any asset at any time immediately and tell, is the slope positive or is the slope negative? Now, not everybody does this. A lot of people don't even use moving averages because they're lagging, indicators. That's fine. This is how I use it, and why it works so good is because what this tells me is not, some people use price action in relation to the moving average to determine if we're in a bull or bear market, to determine if we're bullish or bearish. I don't like that because the reason we're using the 200 exponential and simple moving averages is because they give us so much data jammed in to this. So when we're looking at the daily, we're looking at 200 days worth of data. We're not looking at minutes or hours or a day or a week or a month. We're looking at, the better part of a year worth of data, all summarized up instantly just by that little line. So if we look at the price action underneath the 200 exponential or underneath the 200 simple and we say, oh, we broke support, so now we're in a bear market, or we broke through resistance, now we're in a bull market, that doesn't give us an accurate picture of what's going on. When we look at the slope of those moving averages, that gives us a much more accurate picture. And here's a perfect example of that. The 200 exponential moving average actually flipped over red here when Bitcoin was selling off, but then it recouped from that level. And we notice here that never did the 200 simple flip over red. It stayed positive this whole time until recently. So what does that tell us? It tells us that if we were only using the 200 exponential, we might have gotten the wrong picture right here. It tells us also that if we were just using price action below the 200 exponential, we would have said right here, oh, we're in a bear market now because we're closing below it. Oh, we're definitely in a bear market now. We're definitely in a bear market now. And then look, we reclaim those levels and then we start to put in higher lows and continue to the upside. So it's like, well, are we in a bear market? Well, I was wrong. Or you could do what Wall Street does and say, if something sells off 20%, we're in a bear market. Well, sure, Bitcoin drops 20%, dozens of times per year. Altcoins even more so. So how is that useful in crypto market? It's not. I mean, it's great, sure. Say we're in a bear market every time we go down 20% and we've had, 93 bear markets in the last 10 years. That's fine. That's useless to me. But this, what we're looking at, this only happens rarely. And when it does, it tells us something is changing in the market. So let's zoom back now and we're just going to look at this futures chart and we're going to look at how the TJD Master is telling us and what it's telling us. So let's keep in mind the futures chart actually is not that old, so we don't get a lot of data from it. It started in December of 2017, And that was literally right when Bitcoin basically was going into a bear market. So we'll notice there's a lag of literally 200 days from when these moving averages are populated. So this is when this chart started, and then 200 days later, the moving averages populate because they have to have 200 data points before they start to plot on the chart. So if we look at when they were plotted, you'll see obviously that they were exactly in the same spot. They start in the same spot, but then we'll notice that the pink one, the 200 simple, no, I'm sorry. Yeah, the pink one, the 200 simple, continues down and takes longer to respond, to roll back to the upside. As where the 200 exponential, rolls back to the upside much quicker. So again, by using both those, we get a more accurate picture of what's taking place. But we'll notice that as long as those were red, we were very clearly in a downtrend now. We can look at that and tell easily. But when this flips over, and again, I'm going to turn off the price action for just a minute, just so we can get like the clear picture. You don't even need to know where the price is at. All we need to look at is when these flip. When that 200 exponential flips blue right here, it flips red one more time, and then it goes blue, and then we go, basically parabolic after that. The 200 simple flips, and then what happens after that? I mean, price action literally goes up, just from the moving average to moving average, 55%. So we're able to easily capture a 55% move. Arguably, you could have got in from between 5,000 and 10,000, 100% move, etc. All that's beside the fact. So then we'll see again here, we have this little crazy period where, we basically start selling off and the 200 exponential flips back over red, warning us that there's potential that we're about to see some damage. And then we see here the 200 simple flips over as well. And that tells us once the 200 simple flips over red here, once the 200 exponential flips over red here, it tells us we're now officially in a bear market based on how I determine a bear market. Not once price action is below those moving averages. The bull market doesn't start once price action is above those moving averages. The bull market starts once the moving averages have flipped to a positive slope and flipped blue. The bear market starts once those moving averages have flipped red. So now if we look at what does that tell us based on the actual price action, well, what happened here? We flipped right here at 5,300, and then we literally went up to 14,000 right afterwards. So that was a perfect signal. Perfect signal. I mean, you couldn't ask for a better signal than that. Sure, maybe you could have got in lower, maybe you could have got out sooner, whatever you want to say. But the fact of the matter is, Bitcoin moved up 155% after that. Now let's look what happened right here. This is when I was calling for a massive drop. This was right before the Rona hit, before anyone even knew about Rona. This candle right here, this breakdown was in March of 2020. And nobody was expecting a capitulation. No one was expecting this like massive sell-off and the markets to just absolutely crash. But look what the moving averages were telling us. They were literally telling us ahead of time. We already had flipped, broke down below the 200 simple, and then it acted as resistance right here. And then the futures chart gapped down below it. And we now had a red slope, red and pink, on both the 200 exponential and simple moving average. We then proceeded, assuming you didn't look at anything but that, and we just went by this candle right here. We literally had a 48% sell-off almost instantly after that took place, within days. This was over a 7-day period, 6-day period. We had 50% drop in Bitcoin. And then what happened back here? We flip it back over to the upside. We're back on top of 200 exponential, but the 200 simple takes longer to respond. And then right here, we finally flip the 200 exponential and simple back over again. And again, that's at 93.40. And then what took place after that? A massive bull run. 93.40. So if we went, when these flipped over blue right here, and we just captured this move here, that was a 595% move. If we got in at that area, and if we got out, let's say once we broke that down below here, etc., that was still a 291% move. So that's determining very clear and powerful trends to the up and downside. Now, we can't technically measure this one because we don't know exactly when these moving averages flipped, but it probably was somewhere around this area if we could look back further, and we can tell on the spot chart. But that was a 75% move to the downside. That was 58% move if you got back in once it flipped back into a bull market. So this is telling us very simple and very easily how to do something based on no biases, based on literally just math and trend. And it works, obviously, very well. We'll look at something with more time frame like Bitcoin spot chart and get a better idea. But that's the most simple version of the explanation of this and why the TJD Master works so well. And now what we're paying attention to right now is futures obviously just opened back up, but we're seeing now the 200 simple has flipped over pink for the first time. It has flipped over, you know, to our red measurement, and it now has a negative slope for the first time. Now the 200 exponential is going back and forth, and we did have this little symbol right here where the 200 exponential flipped, but the 200 simple never flipped. So again, if you were just watching one, you could have got the wrong idea. But here we see we are now in danger zone of the 200 simple flipping for the first time. And technically up until like this candle just opened now, this was red as well. So we were looking like we were getting ready to go into that same bear market. And the last time that happened, remember, was a 50% move. The time before that was a 75% move to the downside. So now that we have the breakdown on that, let's switch over again to our spot chart, and we'll pay attention to what this is telling us as well. So now here again, we can see, we'll look at the most recent price action first. The 200 exponential flipped over right here. The 200 simple rolled over right here. Technically, this would have been a bear market if we were just looking at the spot chart, because we had negative slope on both at the same time. And then again here, we had a moment where it tried to, you know, basically flip back over, but we were able to save it. And now here the 200 exponential has rolled over again. We're below the 200 simple, but it technically has a positive slope. So we're sort of getting mixed signals right now. But this chart has given us mixed signals a couple times in the past. It told us we were technically in a bull market here. It told us we were bear market here. It told us we were technically in a bear market here. And it's telling us now we're technically still not in a bear market. So this one has given us some mixed signals, but the futures chart has not. The futures chart has been 100% accurate. Now let's look at those same time frames. Now here, this is when the futures chart started. But obviously we weren't able to populate the moving averages until much later because, you know, we had to wait basically a 200-day period. So if we look at that 200-day period from when futures started, which was the absolute top of this bull market, that was right here. So this would have been when they started, the futures 200 simple and exponential moving averages. But we see already we had clear indication from the Bitcoin spot chart that the bear market had already started right here, actually. The bear market had flipped over right here because we now had both red slopes on the 200 exponential and simple moving average here. And from that point, you know, obviously depending what you're looking at, but once those flipped over, we then had a 59% move to the downside. So 60% move. Now, obviously, you know, obviously, we would have been much better off, you know, selling the absolute top, etc. But if we go from the absolute top to the bottom, we'll see that it was actually an 84%, 85% sell-off. And then again, if we look at where these flip back over bullish, we got back above the 200 exponential and simple here. And then that was when we actually flipped over the 200 exponential and simple to the upside. And once that took place, again, if we just look from once they flipped over bullish, we see the initial move was over 140%. You know, assuming you just took profits here, that was over 50%. And then again, we see the same thing happening on the spot market, but even better reaction because it was closed when we got that gap down. Right here, we flipped the 200 exponential and simple over negative. So we'll go from the next candle to the sell-off. And we see here we have an over 51% move to the downside. So once again, the TJD Master got us out of that price action perfectly to make sure we didn't take that 50% haircut. But now here we notice that we had gotten a false signal before that, or a warning sign before that, as the 200 simple rolled over, 200 exponential rolled over. So again, you know, it saved us from some negative downside, but much less useful. So 12%. So again, we see what amounts to like a false signal or early signal or whatever from the spot market that we didn't see on the futures market. So we know that the spot market is more likely to give us a false signal or less likely to be correct or more likely to be incorrect, however we want to look at it. But here again, we flip over 200 exponential and simple to the upside and not cherry picking. I'm not going by, you know, the best entry ever. I'm going by the actual close once it flips over. And then again, we had an over 650% move to the upside once that took place. And then again, you know, if we were going to go to where this flipped back technically into a bear market, you know, it would have been something closer to like, can look at it one more time. It would have been something closer to, you know, basically if we exited right here, it would have been 338%. So we know that this strategy, determining if we're in a bull or bear market, and then entering or exiting based on that, and then trend trading or trading with the trend, because we know if we're in a bull trend, price is more likely to go up. If we're in a bear trend, price is more likely to go down. We know that that's giving us exponential returns, because the biggest drawdown we saw was between 50, 75 to 85% to the downside. But the upside potential was 50%, 350%, 600%. So we know that this gives us exponential reward for the amount of risk that we can take, because the price action can only ever go down 100%, but it can go up infinite amounts of percentages. But even if we just say 1,000 to 100, that's 10 to 1 upside, or 500 to 100, it either goes to 0 or it 5x's, etc. That gives us, basically asymmetric returns, which is what we're looking for. And this tells us, do we want to be long or short in that market? So what we're seeing right here is we're at a potential turning point. Price action is underneath the 200 simple. The 200 exponential is already rolled over, and we're well underneath that as well. So literally, if nothing happens and we just go sideways here for 1 or 2 or 3 days, we will get this signal and we will be confirmed in a bear market based on how I determine trend. So that's the TJD Master 200 exponential and simple explained, and the trend, and then also in relation to the futures chart and the spot market chart. So I'm just going to break down the other 2 moving averages on here and how they're determined, how I use them, and why they're so important as well. And then we're going to move on to just some regular TA. So here we have the next 2 portions of this are the 8 and 21 moving averages. So again, I'm going to turn this off here. And the reason I don't just make up stuff. I'm not like, oh, this is the Bravo 9 that I made up. No, I'm using actual moving averages for a reason. I don't use made up numbers. I'm using the 8 and the 21 because those are Fibonacci numbers. If you're not familiar with Fibonacci Sequence, I highly recommend you check it out. It's absolutely phenomenal. It's amazing. But essentially what the Fibonacci Sequence is you start with 1, and then you take the number before it, which in this case it would be just 1 because we're starting with 1, and then you add them together. So we have 1 is the first Fibonacci number. The second Fibonacci number is 2. Because you take 1 and 1, that gives you 2. And then the third Fibonacci number, you take 2 and you look at the last number, and that was 1, so now you have 3. So then for the next Fibonacci number, you take 3 and you take the previous Fibonacci number, and that's 2. And you just go through, and that gives you 5 next. And then the previous number before 5 was 3, so that gives you 8. So that's our first moving average that we're using is the 8. And then you take the next number and you take the 8 and the 5, add those together, you get 13. And then you take the 13 and the 8, you add those together and you get 21. So now we have the 8 and the 21 are 2 of those key Fibonacci numbers. And the sequence goes on and on and on and exponentially because it takes your current number and your previous number, adds them together, and it gives you your next number, and then just keeps going on like that forever. And if you're not familiar with Fibonacci, highly recommend you look into it. It's Fibonacci retracements, Fibonacci extensions, Fibonacci numbers for moving averages, for time frames, etc. But anyway, that's a whole nother video. That's why I use the 8 and 21. And now we'll notice something different here, though, with the 8 and 21 and the way I wrote this code. This is not using the slope the same way the 200 exponential and the 200 simple are. So once the slope has peaked, we see this is a peak, and then it rolls over and it flips red. That's not what's taking place right here, because clearly we can see here there's a peak on both these moving averages, and they flip to a negative slope, but they don't change color. Why don't they change color? Well, because this code is written differently. We notice that once the 8 crosses below the 21, they flip over red and pink respectively. And then when they cross back up, they flip back green. And when they cross back down, they flip back down. So this is our shorter term, or like scalp, or, swing trade, whatever you want to call it, inside of those 200 exponential moving averages. So what does that tell us? The 200 exponential and simple moving average tell us the trend. So what does trading with the trend tell us? It tells us we have a higher probability of success. So if every trade is a coin flip, the price either goes up or down, and time is not a factor. You're either right or wrong. You bet it goes up or you bet it goes down. How can you get an edge on that? By trading with the trend. If we have been going up, the trend is up, so we're more likely to continue going up. And that's just a fact. The trend is down and you take a short, you're more likely to succeed because the trend has been going down and it's more likely to continue going down. And that's where the old adage goes, trade with the trend. So by using the 200 exponential and simple on the 1 day or 4 hour or weekly or whatever time frame you're using it on, we then look at the 8 and 21 to determine when to enter and exit a trade within that trend. So we know that we're in an uptrend here because the 200 exponential and simple are blue. So that tells us we're in an uptrend. So what are we looking for? We're looking to enter on green crosses. And we're looking to exit on the pink or red crosses. Or maybe we don't want to exit at all. Maybe we just want to accumulate more at the green crosses. So we'll just start back here after like the CVD dump. So we'll notice here that we were technically still in a bear market here. So we're not looking to buy. We're actually looking to sell red crosses. But obviously we already did that because that was our dump down to like 3,800. So we're not looking to enter right here because we're technically still in a bear market. So once we're on top of these and the trend is green, so we now have all blue and all green, then we're looking for an entry. So we're looking for a retest of the 200 exponential and simple, or a reversion to the mean, or we just start to slowly accumulate. So once we're accumulating in through here, we're in the trade, and then obviously we see the cross to the downside, so we potentially want to exit and then re-enter when it flips over green again. We don't want to short right here though, because the trend is bullish. The trend is up. So we're looking to take longs when the trend flips over green again. So again, we enter the trade right here at 92.35. And then here we want to take profits on the trade because we see the 821 cross. But obviously this candle doesn't allow us to get out in time. We have to wait until the cross takes place, which happens after this candle. So again, just assuming that we took a scalp trade right here, and then got out at the close of that daily candle, that was a 24% move. So we made 24% to the upside. And then obviously the dump down after that close was, from peak to trough, another 14% to the downside. And then again, we had a false signal right here, 821, but we're looking to long that. It comes back down, puts in a higher low, and then again, goes sideways for a bit, and then here we have a cross again. So once again, we're looking to long this cross because we're clearly in a bull market. Obviously, everything is blue. And then from that cross to the top, we have another 85% move. And then once again, we see that it comes back down and retests, but never flips over red. So we're actually never going to exit that trade. We're going to stay inside of it from here until actually here it ends up exiting at 33,000. So that was 219% move to the upside. And that's your scalp trade or whatever along the way. And then again, we see this actually goes down, and then we're looking to buy the 821 cross again. So we actually get in around the same price. No big deal. We avoid the risk. We get a slightly worse entry price than if we just sat in there. So we take less risk and we get all the reward. And then after that, price action goes up again, another, 90%. If we go until the next cross and then we got out at that, we would get out at this red close right here. And then we would look to re-enter potentially right here. And then again, we see a false signal and then, the cross back down. Now that's just using this. Like obviously we had called out head and shoulders patterns. We had called out triple bearish divergence. We had called out specific other reasons why I use this actually as an exit point. So I got out at 60, I believe it was 63,000, and then again at like 59,000 right here, and then actually avoided this dump based on triple bearish divergence. And then we got back into this trade based on triple bullish divergence, actually right around, I believe it was around 31,000 based off the 4 hour. But assuming that we were just waiting for this, we knew this hadn't actually flipped over red yet. So we were still looking to buy the dips. So again, here we were still looking to buy at the 821 cross. So, which we did, and it's all in the trade group, fully documented. I don't hide my stuff. I don't delete things when I'm wrong or, go back and change things. We had a 60% move back to the upside right here. We took some profits along the way, but again, very profitable trade. Came back down, found support right here. We actually took another long off of these positions here and then rode it to the top. And then again, we were out back here at about 63,000 and have been out of our long position since, with the exception of some quick little scalp trades. So as of now though, technically, based on the spot chart right here, based on the TJD Master indicator, technically we're still looking to potentially long this dip right here. But at any point in time that could change because this 200 exponential has already flipped over red. The 200 simple is dangerously close to flipping over red. So right now is dangerous. The same way this was danger zone right here, but we saved the trend and moved back to the upside. This is danger zone right here, and we need to save the trend and move back to the upside, which is still fully a possibility. But again, now that we've broken that down completely, let's switch back to the Bitcoin futures chart and look at what's going on. This one never gave us that false signal. It did not give us the false signal right here before the Rona dump. It did give us the perfect signal right here before the Rona dump. It did not give us a false signal to the upside. It did not give us a false signal right here with that Bitcoin dump. The triple bullish divergence, it didn't give us a false signal. So we enter that fully confident that we're going back to the upside. And then again here, We had the perfect sell-off right here to get out of this position, but now we have to wait and see, is this going to give us our first false signal ever, or is it going to continue telling us the truth? I think it's going to continue telling us the truth because it's been right every other time without a false signal. Why would it false signal us now? Could it false signal us? Of course, but I think it's very unlikely, and I trust this chart. And tomorrow we'll know, because again, we have red, and then we tried to rally back up. We closed this gap basically on the Bitcoin chart, attempted to rally over the weekend, couldn't do it, and now here we are below the 200 exponential and simple. So we are technically right now, based on this previous candle close on Friday, in a bear market. We're very close to being able to save the trend by just closing back above it, because the moving averages are essentially flat right now. But the longer we spend underneath them, the faster this will accelerate to the downside and the stronger the bear market will become. And I'm going to tell you right now that everybody wanted institutional investors. The institutional investors are here now. They have showed up. And you know what the problem is with institutional investors? They don't believe in shit. They don't care about Bitcoin. They don't care about crypto. They don't care about decentralized. They don't care about the future. They don't care about the blockchain. They care about one thing and one thing only: money. They care about money. Unlike cryptocurrencies, they are businesses. They have to actually make profits. They have to do good by their shareholders, or if they're private equity firms or investment firms or family office, whatever it is, they have to try to make money and beat the markets. So they don't care what they're buying or what they're selling. They're trying to make money, percentages. They have to do their job good so that people will give them more money, because they make a spread on that money. The more money you give them, the higher percentage they get to take, the higher their cut is based on that percentage that they get to take. So if they can build confidence and do well, they make more money. They do not make money off your money if it does good or bad necessarily. I mean, a lot of times you do see, like, a 210 or something like that, or whatever the situation is. Basically like a set percentage for just managing your money for you, and then a larger percentage if they outperform the market or, a certain goal, etc. So like, if they perform poorly, they still get 2% no matter what. Kathy Wood gets that 2% no matter what. No matter how bad she does, how much money she loses of yours, she gets 2% regardless. And then on top of that, if you outperform the market or outperform whatever predetermined goal you have, let's say, you're going up against the S&P or the Dow Jones, which did like 28% this year. If you did over 28% on that managed money account, you would make 10%. And there's different ways it could be determined. It's not always 210. There's lots of other, it might be better than that. It might be worse than that. It might be actively managed, might be passively managed, whatever. There's tons of differences, but they have an incentive to beat the market, not necessarily an incentive to just say, I love Bitcoin and I'm long it forever. No, they don't give a damn. They give a damn about that fiscal period, that 1 year period, and beating the market so they can make a higher spread. And they care about outperforming the market because the more confidence they get means the more money they get, which means the higher percentage they get, like same percentage, but off of a larger dollar amount. And then if they beat the market, they got more money now because they're doing well, and they get a higher percentage because they beat the market. So they double do well. So again, we have 4 factors. You either lose and get a set factor and it's not as much, and then people lose confidence, so they take money out. You have outflows from your fund, so you make even less money, and it's a death spiral. Or you beat the market and, more money comes in because you're crushing it and you become popular, or people just want to flood their money to you because you're doing so well. So you go exponentially to the upside. So that's why it's so important. And those same people, that smart money, those institutional investors, those market makers, whatever you want to call it, they don't care about Bitcoin. They don't care about Ripple. They don't care about Ethereum. They don't care about the Dow Jones. They don't care about Tesla. They don't care about anything. They don't care about the future. They don't care about your argument here, there, and the other. They care about money. They care about money, and that's it. And that's their job. Their job is to care about money, not fall in love with an asset. Because you can say, I'm a hodler. I'll never sell my Bitcoin because I believe in the future. They will never say that. They might say, I'm going to keep a small percentage of it regardless because it's a hedge, or, it's not a correlated asset, or, it's smuck insurance, or what. They can have a lot of arguments, but their argument can't be, I believe in this, so I'm going to hold it, because that's not how you make money. And their job is to make money. And if they are doing that, they're dumbass, and you don't want your money with them anyway. Remember, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. But regardless, that's the breakdown of the TJD Master, how I use it, why it's so important. And this is literally the basis for me determining trend. And determining trend is one of the most important parts of my personal strategy, because if I'm trading with the trend, I'm no longer flipping a coin. Because anyone can literally step up with no intelligence whatsoever and can coin toss and win. They can win a bunch of times in a row. You could flip a coin with a random person and they could beat you 10 times in a row. They call heads 10 times in a row and they're right every time. Maybe they call heads and tails alternatively every time and they're right 10 times in a row. But I promise you this, they have no advantage based on the previous flip. They have no advantage based on what they think's going to happen or anything. It's completely random. But they could still beat you 10 times in a row, or they could lose 10 times in a row. But when we start getting that advantage by using moving averages and momentum in our favor, that's when we gain the advantage on the market. So now instead of taking a long or a short, by using the moving average and the trend, that gives us an advantage. So now instead of a 50-50 coin toss, where just anybody can win, we're using those moving averages and the slope on the 200 exponential and simple, specifically on the daily in this case, but whatever time frame you're looking at, we're using those to determine trend. So now maybe we have a 60-40. Maybe we have a 60% chance of success and a 40% chance of failure if we trade with the trend. So if the trend is telling us blue, saying go, bullish, we have 60% chance of success. So our trades are more likely to play out. If the trend is red and we're trading shorts or selling our assets, again, maybe we have 60% now instead of 50-50. So we have an advantage again to the downside without taking into account like risk reward ratio. That's literally just taking into account probability of success. So by using trend, by using moving averages and trading accordingly with the trend, we increase our probability of success. So that slight edge on the market, that alone gives us an edge and makes us more successful than if we weren't using it at all. So that's our starting point, our beginning principle for everything we do in these markets is trading with the trend. And that is why this indicator alone is so important, because it takes all that and it takes everything that I just took all this time explaining and everything that I have taken years and years and years to figure out on my own and all this stuff and figure out what's best, the crosses, the slopes, the 200 exponential, the 200 simple, all this stuff. And it makes it so just anyone can pick it up, spend a couple minutes studying it, learn how it works, and then immediately start using it successfully. So we have one component and it's already made us better. It's already increased our probability of success. And the best part about it is the way it's color coded and the way it just screams to you bullish or bearish. We can flip between 200 assets every morning when we wake up, or every night before we go to bed, or midday or whatever. And we can just flip it on. We don't even have to look at the price action. We don't have anything subjective. We're not deciding, do we think this is bullish or bearish? We don't have to look at news articles. We don't have to think, oh man, I don't know, Elon Musk said this, and I know there's some Tesla's strong, but the solar hasn't been doing this. Take all that bullshit out and we can just look at the moving averages and the slope of those moving averages, and it tells us, do I want to be long this asset? Do I want to be short this asset? Do I want to just wait and see because we're at an inflection point? Like right now, maybe we're at an inflection point. You don't want to be long, you don't want to be short. You just want to sit on the sidelines and wait. I'll wait to see what happens. Looks like there could be some turmoil in the market. Either we're about to go to the upside or about to go to the downside, but right now I'm not sure, but it looks like things could change to the downside. We could save this price action and go up, but right now is the last place I want to be, is in these markets, or at least high risk, as opposed to a situation like this where we have the 8 and 21 cross to the upside, the 200 exponential and simple cross to the upside. It looks like we're getting ready to start a bull market. That's risk on for me, baby. And even though we got out temporarily right here based on this head and shoulders pattern, shout out to the group members on that. Even though we got out right here, we got back in based on this. We were expecting actually a retest of the 200 exponential and simple. So we didn't even get the price action sell-off we wanted, but that's even more bullish. So again, that just put us in an even better spot to capitalize on this bull market. So again, without being too redundant, that's why the 200 exponential and simple are so important. That's why the 8 and 21 crosses are so important. And that's why using these things together are so important. And, sure, anybody could take the time. They could learn how to code. They could learn how to write Pine script. They could not have the color coded changes. They could not have this strategy or whatever. They could just use these same moving averages and just look at them and determine it. But it saves you a ton of time and effort. And not to mention, I'm giving away my strategy for free. So even if you don't want to pay me and buy this indicator, or you don't want to join the trade group or whatever, the benefit of this video is still yours. The benefit of this strategy is still yours. That's yours for free forever. What I've just told you is the basis of my trading strategy, which is success. And I'm not the only one that uses this, but I'm the only one who combines these things together specifically and can explain them in this way and why I use them. And, obviously I'm making this video on it right now. So that's yours. You can keep that. You can have that forever. But what I do ask is that if you want to participate in this specific indicator, the TJD Master, make a contribution or join the group or whatever the situation is and support my work. Because I'm going to tell you right now, this is one component. I give away all the rest of the indicators for free. Everything else I use is for free right now, except for this one, the most recent one I did. The strategy I even give away for free. But if you think this is all I got, you don't know shit. Okay. And you can ask anyone, the group members, everybody. I do all these videos for free to help and to give knowledge and to help teach people. But the real wealth of knowledge is inside my head. And I'm just trying to share it with you people. So that's the TJD Master. If you want access to this indicator, please reach out to me. Send me an email and, you can join the trade group. I'm switching up the way it works with the New Year's. So basically it's going to be a permanent entry to the group. You get permanent access to the TJD Master. You get permanent access to the group, and it's a one-time fee. As where previously, you pay to join the group, and then there was a monthly fee to join. Everyone that's already in the group will be grandfathered in. Everyone that's new to the group will actually, just have to pay the new price to get in. Until the end of the year, until January 1st, the same structure is still in place. But after that, I'm not going to lie, the entry price goes up to join the group and get the indicator, but then it's not monthly anymore. So technically, in my opinion, I think that's better and more likely to benefit people. I don't want to just regularly have to text people to be participating or whatever. I don't want people to feel obligated because sometimes you don't have the option to trade. Sometimes you're too busy with life. I understand some people are struggling with money. We're probably about to be going into a bear market, potentially on stocks and cryptos right now. So, I would rather just have people get in, start learning now. That's the best time to learn. Get involved, and then we can all be positioned for the next bull market in whatever comes. So that is the TJD Master. That is the breakdown. Obviously, if you don't want to, that's fine. You're obviously watching this video probably for a reason. I also have other indicators that are free, a bunch of different ones that work phenomenally, and they all work together. We have the TJD Jewel Thief. We have the TJD TD MACD. Those are both available for free on TradingView. You can use them as well. You can use I have other moving average indicators that are available for free. There's a bunch of other stuff. But again, don't think about it so much as paying for a service or whatever. Think about it as supporting me. Think about it as paying for your own education, supporting yourself. Think about it as, doing yourself a favor and actually spending money on something useful, your education. Because no one can ever take that away from you, and that's the most valuable thing you can ever have. You could lose everything. You could lose everything. But as long as you're still alive, as long as your brain is still functioning, all the stuff you've ever learned is still up there somewhere. You just got to dig it out sometimes. And that's why it's so important to learn how to do this stuff. Not just watch videos from somebody on YouTube or Twitter or whatever and take buy and sell signals or whatever. It's much more important. Because what happens if I'm gone? What happens if I stop making videos? I get tired of YouTube. What if my channel gets banned? I don't have other social media. I'm not going to, maybe I don't want to do this again because I'm tired of YouTube and their BS. So that's it. I'm gone forever. And now that's it. This asset of yours is gone. You never get access to me again. You don't get my new indicators. You don't get my new knowledge. You never got the TJD Master. So much better if you have this yourself in your own head and you can use it without me. It's great to use both. It's great to have all my free indicators plus the master plus me. That's the best case scenario. All of it, everything. I'll take one of everything, please. But that's not always going to be an option. And I mean, I'm not going anywhere, not intentionally or on purpose or whatever, but who knows what's going to happen in the future. So I would much rather teach each and every one of you to be successful on your own rather than rely on me for your success. But in the meantime, I'll be your crutch. You know what I'm saying? I'll hold you up. I'll help you out. We'll get through this together. And, obviously anybody that's been watching the channel for some time knows I have put out countless phenomenal trade setups that have performed absolutely amazingly and made hundreds and hundreds of % of gains for anybody that's watched my videos. And not to mention the thousands and thousands of people that have gotten my indicators for free. And that's fine. I'm totally cool with that, or I wouldn't publish them. So that's it for the TJD Master, the full-on breakdown. I appreciate you taking the time to look out. If you have any questions, comments, please leave them down below. Yeah, we're just going to continue on with some TA. But before we go today, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly.